Hello, and welcome to Monumental, where we sit down with entrepreneurs, leaders, visionaries, and big thinkers making monumental change. Here's your host, Evan Holiday.
Welcome to Monumental. I am your host, Evan Holiday, and today we have on the show with us John Fortes. John, great to have you on the show, man. How you doing?
I'm doing good, Evan. Thank you for having me on. And anybody that's listening, please go rate and review the podcast, man. It's a great show here.
Yes, I love it. I love it. Spoken like a true fellow podcast host.
We got to support one of another. I know the game. I know what it entails. And if I can help you get some written reviews, I know it helps us as podcasters. So it means a lot for anybody leaving a review.
Yeah, I appreciate that, man. Guys, if you're listening right now, he is exactly right. This is how our podcasts grow, how we help reach more people. But with that, let's dive in a little bit about John before we get started. He is known as the passive investor consultant. He founded the Fortes company, which partners with working professionals seeking to invest in commercial multifamily apartments because they don't have the desire or time to own real estate and fully operate it. And by leveraging John's experience, he has helped families invest over $70 million in multifamily investments. And finally, he is the host of the Passive Investor Show podcast, which we alluded to earlier, and where they showcase the value of investing in real estate funds to provide a true hands-off investing audio experience. So with that, John, let's just dive right in and go into a little bit of your background and how you got to where you are today.
I appreciate you having me on again, Evan. Well, it all started about 2 years ago, but before that, I had about 5 years of analysis by paralysis, literally learning stock markets, trying to understand the game, and I understood real estate better. So when I started doing real estate, when I bought my home that I actually live in, and we started doing improvements and getting it appraised and refinances and all of that, whatever you do with your own personal home. Yeah. It just hit me. I said, I got to do this on an investment property because I'm learning the stock market. And then how do I figure out what stocks do I want to invest in? At the end of the day, I invest in stocks that I like, right? But at the end of the day, on top of that, I invest in CEOs that I like. So it gets to levels of that. So that's kind of how it's familiar with real estate investing as a passive investor. So I didn't know about passive investing when I started. I'm gonna burn my first deal. Ended up buying a turnkey. Fire from a burr, right? So It's still doing well. It's performing, and we decided that was gonna be our first and last single family investment. I turn to my wife, I say, hey, we're going to scale. We're going to go to multifamily. And she says, have you done your homework? Well, she didn't even ask me that because she knows I do my homework. So she hates going to TV shopping with me because she knows I figure it out which one I want. But I ask the questions to see if they know anything else about something, whatever, right? Or have some product that I haven't seen yet in the back or something. But anyways, let's continue on. She's like, all right, you did the homework. Let's go ahead, and showed her everything. And we prayed on it, sleep on it, make a decision, and then invested in some education. Next thing you know, we're partnering in JVing with 62 units. 6 months, 5 to 6 months after that, syndicated our first deal. And about 7 months after that, we syndicated another deal. And right now, since that all happened, we have exited from our first syndication in 15 months. Wow. And gave our investors a 1.5 multiplier in the middle of COVID. We exited in the middle of COVID at the height of it. Everything was all lined up, and it was just the ink that needed to be signed and dotted lined and dried, and then we moved on. So that's where I am right now.
That's awesome, man. So what got you interested in specifically in multifamily investing? What about it did you understand and like?
Well, the funny question is when I'm closing my multifamily, my single family home. Everything I was listening to podcasts and came across was just multifamily. It was almost like I wasn't looking for it. It was almost like the signs were telling me, hey, you need to scale. You're not going to do one by one single family homes. So what are you going to do? You look at scaling, you look at efficiency, you look at ways to get more roofs. More doors under one roof. So what does that look like? Multifamily. Do I want 3 families and duplexes? I started looking that way. And then when I started learning about commercial multifamily, that's when it just made sense, because everybody was just spitting podcasts and spewing commercial multifamily. And at the end of the day, Evan, they always say it, right? You're eventually going to scale and move into multifamily from single family. So I decided to just pivot immediately and just focus on diving into multifamily. So that's what really did it for me. I don't know what moves other people, but eventually, if you're going to get there, I might as well move there, transition immediately.
Yeah, exactly. You're exactly right. And that's where growth comes too, is if you can say, hey, why take the path that everybody else in front of me has taken, or everybody else thought was the logical progression? Why not like leapfrog that, multi-year, multi-deal phase of, doing smaller deals? Why not just jump right to the deal that I want to be doing and get to scale a lot more quickly?
Absolutely. I know that at the end of the day, if I did 1-to-1 single family transactions, I would have to do about 1 a year, where, to get to eventually, how many did I need at that time to replace my salary or whatever I was looking to do. A lot of people don't know this about me, but one of my passions is basketball refereeing, and I want to be available to that. I do it at a NCAA level, and being able to go ahead and have my availability there is important to me to pursue my passion. So investing in multifamily allows me and affords me the time to do that. So if I was to do that and stay on a single family home track record or progression, it would take me years to be able to finally have that availability and say, all right, I'm good now. But multifamily allows me to scale it efficiently. And when you learn it and you're working with some experienced partners and you're getting education, and you're just, if you got a thirst for knowledge, you're going to learn something. And if you got something pressing you and pushing you, you're going to do it faster. So that's what was pressing and pushing me to do it faster as I start to move through the ranks of the officiating world.
That's awesome. Yeah. I mean, you're taking the mindset of like, hey, I can literally unlock all this free time for my passion, for my work, and for the refereeing, and for your family too, as well. And for, limitless possibilities of whatever you want to do outside of investing. That is the power of scale. That is the power of multifamily. That is the power of realizing and setting visions and goals around that. So did you have mentors along your journey, or how did you learn to get into multifamily?
What's crazy is I don't have a mentor or a paid mentor. I purchase educational platforms, and my mentorships came from asking questions, and people were willing to answer. I ask a million questions if I need something answered. I've built some great relationships, gone to conferences. I still try to go to conferences. They're all virtual now. I think the value is in with networking, and I understand the value in mentorships. Trust me, if I had a paid mentor or a mentor, I do have a mentor right now with the fun discussions that we've had prior to the show. Yeah. And if you want, we could dive into that later. But if I had a mentor diving into multifamily, I probably would have achieved a lot more faster. But I don't know, because I don't want to live in the past with the what ifs, right? So end of the day, I feel like it would be more efficient. I know people that have mentors and they scale tremendously. And even if they come into the game with no experience, it doesn't surprise me. It doesn't surprise me to see how fast they move from here to here, A to B, A to Z, however you want to paraphrase it. It's just amazing to see how fast they scale, and they do it correctly because they're working and partnering up with the people that are already doing at a higher level with them. And then when they become known and they're able to take on their own deals, they already have the expertise. And the best part is they have the network to go ahead and tap into that source. So at the end of the day, Evan, I don't have a paid mentor, or I don't have a mentor in general, but I do have a network that I can bounce questions. I have private communities that I can jump in and ask something, and I know I'll get a ton of feedback. And I do a lot of research, as we talked about earlier. If I'm experiencing something, for instance, when I was exploring the fund where we were talking about before, if you want to dive into that, we can dive into it. But quickly to recap it is I sourced out who's doing funds.
Yeah.
And I wanted to learn from them. And I asked a ton of questions, and I went back to the basics, asked a ton of questions, network with who you know, and reach out to anybody that's literally going to spend some time to answer some questions for you. I don't pepper them with, boom, 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 boom. I ask them one question at a time. And if I have more and I feel like they're engaging with me and they feel like they like me, they're going to answer my questions. But I don't ask them 10. I don't send them a list of 10 questions. I ask them one at a time. It's probably the most pressing question I have, because I could figure out everything else. If it's like one of those things where when you get one question answered, it kind of answers a bunch of little questions that you have.
Yeah.
So you don't need to ask the little questions. So find out what the biggest roadblock is of a question you have and ask that one question when you're reaching out.
Yeah. I think that's a great analogy just in general in business and mindset and how you're looking at business strategy is figuring out what is the one or two roadblocks or hurdles or unknowns about a business or a strategy or real estate or multifamily investing, or learning a new tool or technique like you're talking about with the fund. I think it's figuring out what are the one or two roadblocks that, if you figure that out, then all the other roadblocks then become either less important or moot point, or they figure themselves out along the way. I think that's always the most important. I tell people that work with me at Holiday Ventures, I say one of our main, most important jobs as multifamily investors and developers is to figure out what are the 1 to 2 things that are the biggest roadblocks and figure those out first. Because if you can't figure those out, then nothing else matters.
Absolutely, man. I agree with that. Well said.
So speaking of fund, we brought up a few times. Let's dive into that. Tell us more about what are you doing with the fund and what is that like building that out and how did you kind of learn how to put that together?
So it's kind of a demand with the market, right? So for instance, Evan, if you're a passive investor and you're investing in one-off syndications and, deal by deal, you're probably looking at, let's say 5 investments from 5 different sponsors, maybe more, maybe it's 10. Great. That's a good number for a busy professional. That's 10 calls you got to jump on, 10 offerings you got to look through, parse through. And that's 10 just analysis that some investors really like to do the underwriting themselves before they go ahead and do that. All right, great. That's fine. If you like that sort of thing, keep going with it. But also, if you have $1 million sitting there and you're waiting to deploy it in one-off syndications at $100,000 or $250 a clip at a time, it's not efficient for you. You're a busy professional who is a master at doing what your day job is, whatever that is, and you produce a high income. That's awesome. You and your family are pretty good. But now if you're trying to beat inflation, you're making these one-off individual investments with syndications, and there's nothing wrong with that. I think it's awesome. Now, a fund allows you to go ahead and do, let's say you have $1 million, you're going to invest $500,000 into that. Now that fund allows you to diversify through the fund and get 1K1 back. Now, let's say you spent 5 syndications on $250 a piece. That's 5 different K1s that you're waiting from 5 different operators, or maybe the same operator, but every K1 probably comes at a different date.
Right.
Maybe, hopefully they blast them out all on the same date if you're working with one operator. But still, it's the time factor of a fund for passive investors. Do you want to sit through one investment call, one capital raise, and discuss what the fund will be used? A fund also could be a blind pool, or it could be a mixed bag of goods that you want to use as basically you'll see is a blind pool or very direct or a mixed bag of the two, right? What I do is I like to be very direct. My fund is multifamily value add strategic plays. I like singles and doubles. If you're a baseball fan, I'm not trying to hit the home run. I'm not trying to reinvent the wheel. I know from my personal portfolio, I have a heavy lift value add project in my first project, 62. I would never bring that type of deal to investors because one, it's too much of a heavy lift with no cash flow for the first year. I don't want to do that to investors. I like straight cash flow from day one. That's my type of criteria. That meets my criteria and that meets our firm's criteria. So we're looking to create a fund that is a value add, whether it's 15 units need to be renovated out of 100 units or all 100, as long as it meets our criteria of a value add where we're cash flowing from day one. We have we're just looking at those type of plays for singles and doubles. Now, you asked about the fund as far as how did I learn about it? I reached out to people that are doing it at a higher level. I joined conference calls, webinars. I LinkedIn them. I've emailed them, and now I have someone that has been mentoring me on the process. His first fund was a $10 million fund, and as of today, he is raising on a $400 million fund. It's been pretty awesome. You find mentors by asking questions sometimes because they see something in you that reminds you of them. So it's just weird how things happen like that. And other firms, learning how other firms are using it, it's different. Some firms will use it as a blind pool, where we'll talk about that, where they get to go and invest in any type of let's say real estate or any type of multifamily. If it's a blind pool multifamily, they can go and do a ground up construction, or they can go do the singles and doubles that I like, the simple value add plays.
Yeah.
End of the day, it's a pool. It's a fund where you'll get 1K1. Now let's say a $10 million fund, and they go and invest in 5 deals at $2 million a piece. That's 5 deals that you're diversified in. If one deal goes bad, guess what? You still got 4 to help you out. Now, if you go and invest in a syndication and that one syndication goes bad, that's that syndication. So I like my odds with the fund. Also, here's why I like firms that do funds. A firm that does a fund, they're probably looking at 100 deals a quarter. It's not 10 deals a quarter that maybe you're doing as a one-off syndication, because you got probably 5 sponsors that you're tied to. What if they send you one deal a month? Is that equivalent to 100 deals a quarter? Absolutely not. You're a busy professional. Leverage the firm. Evan, I know that you do development. How many deals that you get that you have to parse through on a quarter basis? It's a ton. You don't even have to answer that. We all know. Yeah. It's a ton. Your firm is parsing through these deals, finding out the good ones from the bad ones. Leverage the firm in their fund. So if Evan had a development fund, I can trust Evan because his firm already knows how to look for development deals. Already knows what the deals are good ones, what the and in general is what operators are really officiating at a higher level. And Evan's already a good operator, so he's partnering with other operators through the use of a fund that allows him to get better efficiency and the one thing for it that helps you out, Evan, is you have the capital to go ahead and tell your partners, we got your back. We have the capital. Take down that deal if it's a really good one. We like it. Go ahead and do it. Now, here's the difference. And I know I'm long-winded on this one, but here's the last piece to that. If you didn't have the capital up front, you would say, hold off on that. Let me go ahead and write this up and then raise the capital and then come back and say, go get it. Right? So it's a little bit of different scenario when you're JVing with others, and that's the use of the fund, that how we're going to be using it. We're JVing with other firms that are coming across with the great deals in the target markets, emerging markets that we like, that meet our criteria. So that's a little bit long-winded, but we could dive into any piece of that if you want.
Yeah, I love it. So I think for me, what I'm picking up is, it's the scalability. Like having that amount of capital, almost like dry powder, as sometimes people call it, of having all that available equity to put into deals, to put into investment opportunities as they come along, gives the fund and all the investors in it and the operator of the fund more power, because it allows more diversity of deals to come across your desk, because you're going to have opportunity to not just go for deals that, you would find if you were just looking on your own, but you can go out and basically target into other operators and figure out the best operators and align yourself with those operators. And then you get a much wider array of types of deals, and you get to basically pick the best of the best deals to invest in because you have that capital available. It gives you a lot more negotiating power, I think. Absolutely.
And Evan, we're both in this business, and we already know who's new as opposed to who's experienced. So we have an easier time of, I guess, parsing through partners. For me, it takes me a year to partner with someone. If I have to know you for a year and really have a great relationship for you. Mm-hmm. I specifically target a year because I know I've been doing this for the last 2 years, but I'd learned a lot of who to be able to do work with, and who I want to, the type of people I do want to partner with, and the type of people as opposed to I don't want to partner with. So we have a lot more insight into the business, as far as not in a good or bad way, but like we can parse through things a little bit more efficiently than we would if we were new into the business, even as a passive investor. The thing is if you're going to JV with someone, I would give it longer than 3 months. Heck, longer than 6 months. Know who you're going to be marrying for the next 3 to 7 years on a particular deal. All right. So end of the day, if you have a good relationship, Evan, if I have a good relationship with you for the last year, you bring me something, I might be more reluctant to say yes. It's just like how we partner with passive investors. Usually it takes a year to form some relationships. Yeah. End of the day, Evan, sometimes it takes us a year to build relationships with JV partnerships. So we're not just going out here willy-nilly and investing with anybody that brings us a deal. We're parsing through those hundreds and hundreds of deals through our contacts and through the deals that we got through the brokers that we're kind of parsing through as well. So we're making decisions, and we know how to weed them out efficiently at the end of the day. Yeah. Yeah. I love that. And I think too, it gives you, like you said, also the other benefits are you can pull the trigger more quickly on deals. It just gives you a lot more power negotiating that too. And then also it allows you to diversify, and your investors to diversify with just having that 1K1 instead of, I mean, that's honestly, I get that question a lot with investors. They're like, hey, when, like before they invest, they're like, can you give me some sort of guarantee, or at least give me a timeline of ahead of time of when I'll get my K1. Because a lot of investors, the more K1s you get, the more troublesome it is. And you usually have to delay your tax return, and it becomes this ordeal of like, hey, when are all my K1s going to get in? So having that clarity of just, hey, 1K1, it makes a big difference. At the end of the day too, it allows your accountant to know that all these investments are tied to this deal. Yeah. And whether it makes it easier or harder for them, they know that they can get all the financial forms they need for those investments in Fund 1, right? So Fund 1 has 5 investments. Great. They get all 5 of those. They go ahead and generate 1K1 for all the investors in the fund. It sounds, at the end of the day, we know that that's one of the biggest pain points for investors. Why not solve it instead of creating one-off? Doesn't mean I'm not going to be doing one-off in the syndications anymore. I love the model of being able to go and take down things more efficiently and streamlined. I love that. And that's why I took it upon myself to learn this fund concept. I thought it was, one, beneficial for passive investors. That's my focus. I focus on the passive investor experience. Now, what if I'm not giving them the right experience because the fund is more efficient? I need to offer the fund because the fund is something that's more efficient for passive investors. Because I think, like a passive investor, if I want to give investors the best investing experience, I have to be able to generate some sort of a product that's gonna give them the best passive investor experience.
Yeah.
When investors are coming through your pipeline, it's through the process of a few forms or even through a referral. And what does that look like? At the end of the day, they got to get on a call with you. They got to understand and ask the right questions. Are they asking the right questions? Are they vetting you? And at the same time, Evan, you're vetting them to find out if they're the right fit. And believe it or not, I know that you've turned down investors because they might not be a right fit. And I think people find that hard to believe sometimes, right? So, but it's true. You want someone that's not going to worry about their capital. If you got someone that's really, really nervous about making an investment like this, because it's an alternative investment. It's basically, I'm handling my finances on a certain level to send you a wire. People don't make wires like that all the time, at least beginning investors. But when you get accustomed to this, you're okay with sending $100,000 wire because you know it's an investment in your time. You're literally, if you're like me, if you're anything like me, your battle is against inflation. I'm trying to beat inflation 1% at a time, and that's my model. That's how I make my investment. Not that I'm jumping in everything. I have criteria that it has to jump through. But at the end of the day, my capital, I'm a little bit more comfortable with sending a wire than I was, let's say, 2-3 years ago.
Yeah, you're exactly right. It's a big step. Some of our first time investors, they sometimes don't even know how to complete a wire. But that's a whole nother story. There's an education process to it. But once you get them into that routine and that comfort level, it's a game changer for them and as an investor, and the opportunities for them become endless. But I want to go back to the fund real quick. So what was one thing that you were kind of caught completely by surprise in learning about and setting up your own fund? Like something that was maybe more difficult than you realized in setting up a fund?
Well, it was more like the structure of the syndication, right? So let's walk down the simple syndication. Let's say 8 pref, 70-30 split, 70 to the passive investors, 30 to the general partners. And that's a simple waterfall, right? So 8 pref is met and then the split happens.
Yeah.
So the fund, and then you have let's go back real quick, the syndication, and then you have a 2% asset management fee, right? All right, great. So that's the structure. Every investor knows that that's basically the template for a syndication structure. The fund is more of a 2 and 20, right? Think of it as like, I don't know if you're familiar with hedge funds, but think of it as a 2 and 20. You can do it as 2 and 25 or 1 and 20 or 1 and 10. What that means is the first number is the asset management fee. So 2 is the asset management fee for being the manager of the fund. the 20 is the carried interest. So let's say my fund is a 8% pref, and you got a 2 and 20. 2% asset management fee. So the fund is charged 2% every year to manage the fund to the firm to cover the cost expenses of the offices and all that for us to parse through all those deals. All right, great. How does the 20 work? So once the 8% pref is met, everything after 8% is now split 20 and 80. So 20% goes to the general partnership and 80 goes to the LPs. So let's just say I'll use $100 and you got 80 of that. Once the 80 is met, the rest of the 20 is split 20% goes to the asset manager, to the general partnership. So it's a 2 and 20, 2 and 25, 2 and 30, however they're structuring it. On a fund, usually it's a 2 and 20. That's the model that they go with. And 8% returns on a fund, that's great. But the fund also has a longer term. So what that looks like is on a syndication, you usually invest in anywhere from 5 to 7, maybe even 10-year holds. I've seen a little bit of those, but a fund is yet straight 10. You can do it on a 5, 7, whatever, but preferably it's a 10. 1, it gives you runway, right? 2, it allows you to call capital as needed. So Evan, you invest in my fund. Let's just say you invest $100,000 into the fund. And I tell you, when on the closing day of the fund, you're going to send 25% of your committed capital of $100,000. You're going to wire $25,000. Now, we call capital down as needed so that not all capital is being charged the asset management fee from day one. And also, it's not sitting there being not used, and now we have to give you the pref on it, right?
Right,
so
right.
If it's not called down, then at the end of the day, we have 4 years to use that. We have 4 years in the investment period to make investments that basically meet the fund. So if we got a $10 million fund and you got $100,000 in it, we might call down in year 2 another 25. We might even say another 50. So let's say it's 50. Now you got $75,000 into the fund. Now you got 25 remaining. What happens after year 4 if we haven't found an operation or another asset to invest in? That capital is now released, and the fund is what it is. When I say released, your capital is no longer committed to that fund because we didn't meet the last investment, which is a great thing because we're not forcing investments. Yeah. Now you know that, okay, now you can go ahead. Maybe fund 2 is already opening, and now you know you can throw that capital to fund 2. Maybe investments are starting to come back from that or exiting from that fund 1, and now it gives you more capital to deploy. Now you want to invest 150 into the next fund. It just allows you to keep going and beating inflation. So it's a call down practice, is a 2 and 20 structure, 2 and 25, however you want to do it. And that's basically how it's split, structured, and how you work it. There's other ways too. Some people do call all the capital down on day 1 and sit on it. And they only say that if the capital is uninvested, you're only getting a 1% return until it is invested. There's many ways to do it. Yeah,
that's interesting. That does kind of peel back the curtain for me too. I told you right before we dove in, probably in 2021, we'll be doing a fund with Holiday Ventures. So this is just as much about me learning as our Monumental audience too. I love this. Yeah, exactly. That's why I love podcasts. But I did want to ask, so how are you going about pitching this fund, or when you're speaking to investors, you're explaining this process like you just explained to us, where say, the goal is to diversify, to find multiple deals, to go in, look at 100 deals a quarter. And also we'll only call your equity as it's needed. So you don't actually need all the money up front.
Yeah. So that's a great question. I'm having a lot of warm conversations right now
Yeah.
And my presentation is being drawn up as we speak. I'm spending a lot of time working on that. One of the things investors are going to want to know, because a fund, you don't have investments already. And it's not like a syndication where you have the deal and you're projecting it out this. I'm projecting the fund on investments that I know how they work conservatively.
Yeah.
The fund is underwritten very conservatively. I've created my own calculators, fund calculators, to make sure I utilize the capital correctly. And at the end of the day, I'm trying to get investors 8% and get them their capital of the IRR at 13 to 15 of a 10-year fund. But when I say a 10-year, please understand that capital is returned anywhere after year 3 as we start to exit from investments. So it's not like a question that you asked me before we started the show was, do we reinvest the capital if we exit, or do we return it? We do not reinvest anything. Our goal is to exhaust fund 1. When exits start to happen, we return it back to the investor. And we do that, and we move on to fund 2, and we do that the same thing. And the goal is to get bigger funds as we start progressing and moving on. So that's another question too that you asked prior, and I thought that was important to answer on this call.
That's great. And what, as far as, I guess, what advice would you have for our Monumental listeners that may want to start their own fund, or also maybe investing in a fund? What kind of advice would you have for them?
Starting your own fund, network and connect with people that are accessing, doing it. Yeah. Have as many conversations about it. Learn as much as you can about it. Learn the pros and cons. The pros, there's a lot of pros, and there's a few cons too. Some people like to handpick their deals. Yeah. Investors that are investing in a fund, they're using the experience of the operator to handpick their deals. So, they take the control is out of their hands. So when you're investing in a syndication, you have the control to invest in this deal, that deal, that deal. But in a fund, they're investing in opportunity. So make sure your criteria lines up with the fund manager or the fund firm. That's my advice for investors. For learning, but also advice for investors is make sure your criteria lines up with who you're investing with. I believe you just said that. So because of Evan, if you're doing development, and I've invested in your deals in the past, I'm pretty sure your development fund is going to meet the same metrics as those deals in the past. So I can invest in a fund like yours. If I'm used to investing in a value add opportunity, know what kind of deals that are going to be invested in a value add. If I'm creating a $10 million fund, I'm not investing in anything less than 50 units, but I'm partnering with other people in certain markets and making sure, I have a lot of ties in strong emerging markets. I won't name them all, but Texas, Florida, Carolinas, and Tennessee, right? So I have a lot of ties. I like those markets. I'm south of Boston and I invest out of state. Why? Because I like the landlord friendly laws. I can't invest in Massachusetts. It takes me 9 months to evict someone, and that's 9 months of lost capital, right? At the end of the day, if I put investors in a deal like that, it's not efficient. But I know that there's ways of getting about it. I just don't have the patience to invest in Massachusetts. Yeah. Right? That's my own backyard. I have no investment property here. I have them all out of state. I'm used to investing out of state. Yeah. I'm comfortable doing it. Some people find it as a daunting task, but it's really not once you get your feet wet. At the end of the day, it's about who you're networking with, who you're meeting, and put the fund to use.
I love it. 2 other questions I had about the fund, then let's dive into our monumental questions. Sure. About in your shoes, having done a few deals, having raised private capital, worked with passive investors, you have the passive investing show. what gave you, or what was kind of the tipping point of also being able to say, okay, I feel confident in my ability to raise $10 million in a fund?
Well, it's about the conversations I've been having, and it's when you're growing investors or you're growing your database, you start to understand who is looking for what and what is efficient for them. So if I reverse engineer everything. So if I'm going to invest in something, I want to see what the end is looking like, and then I'll work my way backwards, and then I'll start working from the beginning, right? So I'll build a plan from backwards to beginning, and then I'll start the plan. When I started the Passive Investor Show, I said, who do I want my end audience to be? And I designed it to be passive investors, right? I decided passive investors needed a voice, needed a show to hear something. How was I going to create it? And then the questions came that way. And now I started building the podcast. A lot of the questions came as I started interviewing, and I started scrapping out whatever, right? So as you can see, you're efficient and you get to go. So to answer your question is, know your audience, know what you can do, know what you can't do. Another question that you asked me earlier about the fund, it's easier to do a 506C if you're going to do it on a fund than a B, unless you have all the Bs, in place to be able to do something like that. But if you're going to do a 506B offering, hopefully your audience understands the 506B from the C. The B, you can't publicly announce it. The C, you can, right? In case they don't. So on a B, you can only allow up to 35 investors, and that's it. Non-accredited investors. On a C, you're parsing all accredited. So end of the day, if I'm going to do a fund, I'm probably going to do more of a 506C, which I am going to do a 506C. I can advertise it. I can talk to anybody about it. I don't have to hide. I don't have to hide it and be discreet. But also, I only have to take accredited investors, and I have to verify their accreditation. There's ways to do that. They can also self-verify with verifyinvestor.com and then bring you that form, and then that's that. But there's different ways, or you can get form made up from your attorney and have their CPA sign off on their behalf. I mean, there's different ways to verify accredited investors. So that's another thing too, is what are you strong in, right?
Yeah.
So Evan, are you stronger raising at 506Bs, or are you stronger raising 506Cs? That's just a question you got to ask yourself and figure out. So if you're a pretty good marketer, you probably can do a C, right? It all depends on your investor database and how you're coming across investors. Are you coming across a lot of referrals? Are you networking with some RIA firms? Are you networking with any type of conferences that are, a lot of accredited investors or just individual investors are appearing at? So how are you positioning yourself and your firm? And do you know your investor database well enough to go ahead and have the confidence to raise X amount of dollars at the end of the day?
I love it. Yeah. I love how you said at the very beginning, you're like, hey, I just reverse engineered based on the conversations I was having. It sounds like you already knew that demand was there from your investor pool, your existing investor pool, and then you're doing a 506C. So you're allowed to be able to market that broadly, and you have the channels with the podcast and network and the social media and the LinkedIn, and you have those platforms. So that allows you to, above and beyond your existing network, be able to pull in more capital. So that's powerful.
There's still a lot of conversations to be had, though. You got to answer a lot of questions. So here's the thing, right? So people are usually on my time when I got a deal or something like that. But when I'm raising for a fund, I'm on investors' time. So that's the difference. Where if they say if they say I can't meet you till 7 p.m., I got to meet them at 7 p.m. That's the call, network, Zoom, coffee, whatever, late drink or whatever. Not drink or whatever. But you know what I mean?
Yeah.
It's just one of those things where you're on investors' time when you're raising capital. And then when you're on deal time, when you're bringing, for instance, I got a syndication, it's almost like when I'm working on a deal, it's on my time. I'm going out to the property when I need to go out there and see it. and boom, boom, boom. So there's a difference of there. But end of the day, to be a great, steward of capital, you got to be a great communicator. And it's not to say that when you're on my time, I'm not communicating. That's that's not how it works. When you're raising capital, Evan, you're always on investors' time if they ask you a question. So you want to make sure that they get the right answers, whether it's from you or your team or your investment relations management team. You want to make sure that either they can get it through the investor portal, the answer that they're asking, or they can get it from one of the members of your team that's assigned to the fund or the investment that they're working with.
Yeah, I love that. And one last thing on the fund, what does your timeline look from like when you first started thinking about this to when you're going to start raising, and then when you think you'll close up raising and then start investing?
Yeah, so I was in a mastermind, and I don't know what triggered it. It was just, I was in a mastermind. I had a conversation with a few people, and then next thing you know, I'm off and running, just diving into the fund because something triggered that, hey, it makes sense. It's something that just makes so much sense that I can't ignore. So it was one of those things where if something's bothering you, you need to find out the answer. Like something just keeps like, hey, go and like, it's just triggering, like, go and figure it out. Hey, it's me, the fund. Me. So I just kind of went and I said, all right, let me find out what I need to know. So I asked, what's the biggest pressing question? And the next thing you know, I got that answered. And then all of a sudden I met, the guy who's been mentoring me now, Eric Silverman. He's awesome. And from Eastham Capital. And, like I said, he started with a $10 million fund and now he's doing a $400 million fund. And he says they'll have it all raised in like 3 months. So
that's phenomenal.
It's just having contacts like that. And if I never was looking for that, I would have never asked the questions and I would have never have met him. So ask questions and, things get put in your path to make it happen.
Yeah, it is amazing how that happens. It's like once you start asking questions and you start becoming, as you ask more questions, you learn more, you inevitably start getting more clear on where you want to go and your vision. And if you spend time and energy getting clear and actually writing out your vision, then, the sky's the limit and you can raise $10 million funds and then you can work your way up to $400 million funds. That's phenomenal.
Absolutely. One thing too, Evan, is like when you like you asked me a question like why, I want investors to be able to invest like institutions invest. Institution capital. If you get on programs and softwares like Preqin, you can find institution capital. You got to build relationships with them. Great, but it's an investment that you can make to start funds of 300 million and use institutional capital to go invest. But I want private investors to have that experience of institution investing because they're investing at a high level of multifamily and real estate in general. Yeah. They're just doing it with more capital. They're able to take down capital. So if they're investing in funds, why not give people a chance to invest in funds that allow you to go ahead and take down deals that normally you probably would have had to be, maybe you wouldn't come across because you had to syndicate it and you had to approach it a little bit differently. Now that you have capital and you can put it to work, not to say that you can't underwrite it conservatively, but you feel a little bit more confident going into a deal than you are when you have to go raise it, even though you can raise it. It's just it's a different feeling when you have the backing behind you and the support. Like said, like I said earlier, when I got my JV partners, I'm telling them I have your back. If you come across something like this is the type of investment I'm looking for. Yeah. After my team underwrites it, we'll go and we'll dive in and then we'll partner up and here's the parameters and you have that already ironed out. So that's kind of where it kind of like puts you here instead of here with partnerships. So it's a different style of investing, but it's efficient and better way of investing. I think it works out for all parties.
I love it, man. That's a 10x way of investing.
It is. It is.
Well, let's dive into our monumental questions. What does success mean to you?
Success for me means, just following my dream, my path, and basically, if I can provide for my kids and my family, end of the day, that's success for me. And it's not, doesn't mean like financial or whatever, even though that's all great. I want to create the memories that, I wish I created a lot more of when I was a little kid. I have memories of playing outside and stuff, but I want to give my kids memories of doing activities with mom and dad. And that's just kind of like the different type of experience I want to give my kids and my wife and all of that. So that's what success looks like to me, is families and memories and all of that.
I love that. What about daily habits or morning rituals that you have?
Great question. I meditate every morning. I meditate and then I say my affirmations that I'm looking at right now.
Nice.
And then I come and I journal. And I did a 21-day Deepak Chopra meditation and writing exercise. And that built the habit, and I haven't stopped yet. And I did that in the middle of COVID. Not that I needed to do it. I wouldn't say I think we all could use it, right? I did it because I wanted to dive into deeper meditation, but also I used to write, but I didn't do it consistently. And I knew that this would set up the consistent habit. So sometimes I ask myself serious questions of what is bothering me or whatever. And then sometimes I just say what my day was like yesterday. And that's what I never was able to kind of parse through as far as when I was journaling. So now I just get everything out there, out of my head, and start the day with, clear eyes, full heart, can't lose.
I love it. What about favorite book or book you're currently reading?
The book I am currently reading is So Good They Can't Ignore You by Cal Newport. And one of my favorite books is, and I say this on a lot of podcasts, is oh my gosh, I just lost my train of thought of it.
Nice.
The Third Door. The Third Door. The reason why I like the book I'm currently reading. It's telling me how to obviously be so good. I can't be ignored. But also it's providing examples. I love books that provide examples and illustrations, not so much illustrations, but like paint the picture of what it looks like. But The Third Door to me is one of my favorites because it tells you, so picture this, you walk up to a club, there's the VIP, there's the regular general line, and then there's the back door. You got to jump through the window and go through the kitchen, and then boom, you're in the club, right? It tells you how to think as far as get creative and use the back door sometimes. So that's why I like The Third Door. Yeah.
I read that book a little while ago. That's a phenomenal book. And it really is amazing. Phenomenal story of this guy that it's like a college dropout that ends up like interviewing Bill Gates. It's just amazing story.
His journey took him to some great interviews and in front of some high level people that like the Tim Ferrisses and everybody that he meets and stuff like that. Warren Buffett and all of that. It's
exactly. It's a wild experiences he had. But guys, check out that book, both of them. But that's awesome. I love the recommendations. John, just high level, loved our conversation, phenomenal conversation. I loved, we did a real deep dive into funds, creating funds, what it's about, the benefits, also your experience and hearing your story and how you were able to really just network your way and find your mentors along your journey. I think our monumental listeners can really take a lot out of that. And also hopefully take the next steps on their fund or maybe even investing in a fund as well. So where can our monumental listeners follow you or reach out to you or connect with you?
I appreciate your time, Evan. Thank you for having me on. And like I said earlier, subscribe and review to the show. It's awesome. Please leave Evan a review.
Yes.
You could find me at johnfortes.com, fortes.com. There's also the podcast is passiveinvestorshow.com. And I do a lot of writing, blogging. I also cut out some, for instance, if I interviewed you on my show, Evan, and I know it's not being released for like 13 weeks, if there is a piece of that information that I loved, I'll cut out that video and put it on my website. And the podcast isn't even aired yet, but I think the information is so vital that I feel like I have to put it out there. I don't go and market it, but if you go ahead and say, go to my website and you go to the Investor Resources, Investor 101 tab page, you'll see a bunch of videos from interviews that have already aired or haven't. So it's kind of something I do. I love doing it. And it's the fact that it's information that I feel like people could use immediately, because in that moment of recording, I find it very useful. So I feel like passive investors will find it very useful. Also, I provide investors with a passive investor calculator. And the reason why is I don't care if I'm compared to other sponsors. I want my deals to be lined up with other deals. So it allows you to track 5 investments. It got graphs and charts, and allows you to put the projections in and then the real-time projections from what the actual deal you're investing in is performing as. So I give those to my my investors as well, and that's all free. And it's something that with investor portals these days, Evan, you might have one portal from this company, I might have one from that company, and I got I got an investor that is invested in your deal and my deal. How do we line those up and meet those together so we can track them together and see the charts and all that? That's what the calculator really does for it.
That's awesome. I love that. And I love the Investor 101 tab. I think that's powerful, just giving out that knowledge and helping others take that step into multifamily investing. That's huge.
I appreciate you, man. Thank you.
Yeah, John, thank you again for being on the show. And guys, listen to John also when he says subscribe, rate, review, share Monumental with others. And really, if you enjoy a part of today's episode, let us know. Tag us on social media. Let us know what part of today's episode and what value you got out of this. What value bomb did you get out of this? Because I know I personally got a lot of value out of it. And guys, with that, have a monumental day.